Isn't that enough candy for you now, Matt?
No. No.
Oh, come on, seriously. We're supposed to do the podcast. I think you've had enough.
Oh, who are you, my wife?
Nah, I'm just trying to look after your health.
Yeah, see? You sound just like her. Don't you think 2 glasses of wine is enough, darling?
Well, for some people, 2 glasses of wine would be adequate.
Adequate, meaning an acceptable quantity.
Or quality.
Well, surely that's different for different people. Everybody knows when they've eaten enough for dinner, for example.
But not everyone stops eating when that happens. Some people overeat, and it's bad for them.
Some people need to be told what's adequate, you mean. They need to have rules.
And it's not just people either. It's also banks. They need rules for what's adequate.
So they don't eat all your money.
Kind of. The rules are to do with how much capital they need to keep available in case things go wrong. It's called capital adequacy.
And no doubt, capital adequacy, that's what we're talking about on this podcast, right?
It is.
Okay. So you go ahead and introduce the episode while I suck on this Jolly Rancher.
I beg your pardon.
No, never mind. I'll do it. On this episode of A Dictionary of Finance, we're joined by Vincent Thunus, a risk management expert at the European Investment Bank. We'll be learning about capital adequacy. Hey, get your hand out of my candy bowl. You may remember the Bank Vincent game from a couple of weeks ago on A Dictionary of Finance podcast, where one of the European Investment Bank's top risk managers came in and played a game that was very revealing. It revealed a lot about our characters, didn't it, Ala? It showed that you were a very deeply conservative and sensible character.
Exactly, and you were just reckless with cash.
I was insane. I was a credit risk. I was an interest rate risk. I was everything but a liquidity risk. Although maybe I caused one. I don't remember. Anyway, you'll have to go back and listen to that podcast to find out exactly how reckless I am. But talking of reckless, Vincent Thunus has come back on the podcast. That's really, he's clearly not managing his risk here. He's back. He's ready brave. He's ready to take the risk. So Vincent, thanks for coming back on the podcast.
My pleasure.
The subject of this podcast is capital adequacy. But before we talk about capital adequacy, we have to actually know what capital is.
Indeed. So, capital for a bank is like capital for any corporate. It's basically the money that the owners of a corporate or a bank have put into the company.
And so to get kind of started on the need for capital adequacy, we have to look at the company as a balance sheet. That's the two sides of a balance sheet. And what's interesting in the context of a bank, which is different from regular corporates, is that loans for a bank are assets. They're not liabilities.
Well, but the general concept is the same. I mean, you hold capital to protect your creditors. Mm-hmm. So in the case of a bank, let's imagine that I've received 100 euros of deposits and I basically want to invest those deposits into assets, loans, for example. Let's assume that I just want to extend 10 loans of 10 euros each. Well, obviously, I will be able to basically reimburse the depositors if I'm paid back myself from all the people to whom I've lent the money. So now let's imagine that out of the 10 loans that I've extended, one client is not able to pay back. Then I'm left with 90 euros. And of course, at some point in time, the depositors will ask for the 100 euros. So in that case, if I don't have any buffer in terms of capital, because that's the purpose, I will not be able to meet my obligations. Mm-hmm. So ultimately, the purpose of capital is really to have a buffer against unexpected events so that I can indeed honor my obligations to the creditors.
But now, you say that it's an unexpected event, which, it is. But still, there's a way for you to expect how much that's going to be, and so that's what's very fascinating is that you expect out of that 100 euros in loans that you've given out, how much do you really expect to lose? How much capital do you need to keep for those losses?
I think it's a very good question, because the distinction between expected and unexpected loss is key. So coming back to my example, let's imagine that I know that in average I may lose 10%. So what I could do is just ask for remuneration to cover that risk. And when I ask for interest, I would ask not to pay back 10 euros only, but let's say 11.1 euros. So that if 9 out of 10 of my borrowers fulfill their obligation, including interest, then I will get back my 100 euros, and I will be able to pay back. So it means that I can calibrate the interest I will charge on the basis of my expected loss. But still, I mean, it's just statistics. It remains random. So now let's imagine that there is a second borrower defaulting. Then I'm still in the same problem. So I will be unable to pay you back. So in essence, I have basically to estimate how much unexpected loss, like a second default, a third default, a fourth default. I mean, you can put the limit where you want, depending on how conservative you want to be. And figure out how much capital I need to hold to protect my creditors.
Wow. So in addition to expecting expected losses, you're also expecting unexpected losses.
Yeah, at least we know that an expected loss may happen.
So you need, essentially, in case things go wrong, you need to have enough capital to cover that. Exactly. So that's where the word adequacy comes in. You have to have adequate capital, enough capital to cover those potential losses. But how do you figure that out?
Well, it's basically based on some calculation. So you try to measure the risk that you take. And typically people will try to estimate with a certain probability how much capital you may lose in some circumstances. So in my example, 2, 3, 4, 5, 6 defaults, obviously a scenario where we will have 6 borrowers out of 10 defaulting is probably not very likely. But maybe a second default is more likely. So depending on how the level of confidence I want to have in my estimation of risks, I will put aside the size of the appropriate size of the buffer.
But now, at some point of time, it was decided that we can't just leave it up to the banks to decide how much buffer they need to have. That there needs to be a regulation for it. That there needs to be a common standard. That we can't just allow a bank to decide that I'm gonna be a bit edgier. I'm gonna be walking the line. I'm gonna be making riskier decisions regarding how much capital in relation to the assets I will maintain. It was decided that this needs to be regulated, that there needs to be a common standard for it. Why did that happen?
Well, actually, it happened because we want to avoid, or the community would like to avoid, that one specific event in a bank results into other defaults in cascade, because all banks are connected to each other. And probably there is also another purpose, which is the fact that banks are also part of the way all the economies are working. So, and without banks functioning properly, then you put the economy of a country or even a continent or the world, if there is really a serious crisis, in danger. So yes, indeed, the regulations were developed with a purpose to ensure financial stability around the world.
What's the formula? Is there an accepted formula for how much they should keep? If they have this much risk, you need that much capital?
That's the purpose of all the regulations that have been developed in the past. So actually the Basel Committee has been in the forefront in this matter. So the Basel Committee was created, I think, in the early 70s. Following a collapse of a German bank. I forgot which bank exactly. Exactly with the purpose that I mentioned before. So just to avoid contagion to other banks.
And it's called Basel because it's in that town in Switzerland.
Exactly. Right. And there were a number of accords, as they say, setting the capital requirements and other rules that the bank will have to apply. So, and it started with the Basel I Accord, rather basic, where basically the rule was for every loan or asset that you hold with a credit risk, you would have to hold 8% of a risk-weighted asset amount. So it becomes a bit technical, but in short, it means that you look at your asset, you adjust for the risk, and then you take 8% of this amount, and this is the amount of capital that the bank needs to hold.
Okay, but let's take a specific example. Let's say Matt has taken out a mortgage, which in Luxembourg is, these are huge. It costs a lot of money to buy a house. So let's say you bought €1 million house. So you've taken out €1 million loan. So what you do is you calculate a risk-weighted version of that €1 million, right?
Yes, indeed.
So that's going to be less than that million.
Well, it depends on the risk weight. In this case, indeed, with a mortgage loan, you may expect a risk weight of about 35%.
So it's about 350,000. But if it was €1 million to go buy nice cars, then it would be much higher, right?
Yes, probably around 75% or something similar. So that's the sensitivity to the risk of the asset that is reflected in the risk weight.
And so for that, so let's say it's a mortgage, it's 35%. So it's that €1 million that the bank has given Matt is actually 350,000 in terms of risk-weighted assets. And now the Basel Committee says that you only need to keep 8% of that as a buffer?
Exactly.
Wow, that's pretty. That's still pretty risky, I think.
But the capital, whatever that 8% is that the bank has to put aside, what do they put aside? Do they buy bonds? Do they have to keep cash? What does that?
Money is fungible, so actually it can be invested in assets. And the way to actually measure the level of capital of a bank is just to look at the balance sheet. And this is the difference between the value of all assets and the value of all liabilities. And de facto, the value of your own funds or capital will become zero if actually the value of your assets drop to a level just equivalent to the level of your debt. Or even worse, it can go negative, which basically is then the event of default, where the value of your assets do not cover anymore the value of your debt.
So the bank doesn't take the capital and put it in a separate pot and say, I'm not touching that. They're using it.
It's cash, it's fungible, and based on the investment that you make, yes, you can have more or less risk added to your portfolio. Yeah.
So that's Basel I, which, as you mentioned, was simple. Yes, that's it's simple for a risk manager, I guess. But then there was Basel II, and how did this all develop, and why did it develop? Why was there a need for this to get more complicated? I assume they didn't make it simpler. I assume it got more complicated, more refined. What happened?
Exactly. So, well, the concept remains the same. So what we have discussed so far is still the foundation of the capital requirements for banks as set by supervisors. Basel II was developed to cover other risks. So Basel I was really focused about credit risks. Basel II added other risks, and the concept of pillars, 3 pillars. Pillar 1 would have sets basically the minimum capital requirements, so the 8%, but also capital requirements for the risk like market risk or operational risks. Pillar 2 is basically the concept by which banks develop their own view about the capital they need to hold, and the supervisor comes and looks at this and basically form an opinion and may also ask for additional capital based on the assessment. And the third pillar is about market discipline and disclosure. The purpose was to force banks to be more transparent about their positions. Mm-hmm. and how much capital they hold and the processes they have in place to basically force bank to have better behaviors, I would say.
Does that bring us to Basel III?
Basel III essentially was a follow-up of the crisis of the years 2007-8 and the need to, for instance, introduce indicators and to monitor more closely liquidity. That was one of the main changes.
Well, how confident are people, when I say people, how confident are regulators that these are good measures? One of the things about the 2008 crisis was that banks were selling instruments, particularly in America, but all over, that in the end, ratings agencies and regulators didn't seem to understand all that well. Was Basel III an attempt to rein them in somewhat?
True as well. So I just mentioned liquidity, but clearly leverage ratio also came back into the picture. Leverage ratio is nothing else than comparing the amount of the investment without any risk weight compared to the capital. The idea is that if you don't really understand your product or if your models are too complex and subject to proxies, or if you cannot really measure the risk properly, then ultimately you may lose the full amount. And the leverage is basically comparing how much in nominal terms you have invested compared to your capital base.
So the leverage ratio just takes the amount of capital you have and the amount of loans you've given out, basically, and it doesn't do the risk-weighted assets. It's a more simpler math.
Exactly, it's a sort of backstop limit that banks have to.
And the reason for that is because the public and the regulators did not have enough confidence that banks are good at calculating the risk-weighted assets. Like when you said that this €1 million mortgage to Matt, that's maybe a 35% risky asset. So we would calculate that as 350,000. For a more complex product, it would be maybe difficult for a bank to adequately assess whether it's 350,000 or whether it should be 450,000, and that gets the whole calculation messed up.
True, but I think we still need to use risk-sensitive measures. Otherwise, if you only look at leverage, then you indeed miss the risk dimension. Now, I think it's basically a combination of both limits based on absolute levels and limit based on risk weights that are themselves based on sometimes models, sometimes complex, that indeed need to be, validated, controlled, reviewed, and so on to ensure that they produce sensible figures.
So I want to get at who's actually behind this. Who's doing this? Who's deciding it? You've mentioned Basel, so that's a reference really to the Basel Committee on Banking Supervision, which is part of the Bank for International Settlements. So who is that? Who's the Bank for International Settlements?
Well, the Bank for International Settlements is the central banker of the central banks as it is usually defined. But what is important is the Basel Committee on Banking Supervision for the purpose of supervision. And it's a committee gathering representatives from various countries around the world. And they decide about principles that should be applied in terms of supervision, prudential supervision, and also other supervision regulations.
And then it becomes law.
Well, not automatically. So the rules set by Basel then must be adopted at national level, or when we're talking about the EU, there is a layer in between, which is the EU itself, that can issue either directives or regulations. But for some other countries, let's take US or the Bank of England, these are national regulations that are then put in place to translate the Basel principles into law.
But who checks? So we have these regulations from the Bank for International Settlements. They're given to the banks. The banks say, thank you very much. We'll take them into account. In fact, we'll follow them. Who checks that, let's say, a bank in Germany or France is following those capital adequacy rules?
This is the role of the supervisor. So again, at the level of the EU, this is centralized, and at the level of the euro, this is centralized at the ECB.
The European Central Bank.
Yes,
right.
where they have the single supervisory mechanism. So basically, they perform the task of reviewing and supervising the banks that are under their control, the big banks in the EU and the Eurozone. While in other countries, as I just said, for instance, the Bank of England will be the one supervising the banks in the UK.
Are there some places where the regulator is a bit tougher in making sure that the Basel rules are followed? And to the same extent, are there some where they're not so?
True.
Not so tough?
It can be at the level of the regulation. It can be at the level of supervision. So, I mean, yes, sometimes there are some discrepancies between the way the regulation is applied. But the purpose...
But are there other banks that are not following the Basel Committee suggestions or regulations? I mean, you mentioned that there are 18 sort of jurisdictions or 18 participants in the Basel Committee. I mean, does that mean that there are some banks in some jurisdictions that, they don't calculate this 8%? They don't...
Well, there could be some differences between countries, but ultimately, I think in all those countries, there is banking regulation in place.
Mm-hmm.
And banks should apply the regulation, otherwise probably they will not simply get the license to operate.
Mm-hmm. One thing that we mentioned a little bit earlier, just in passing, was credit ratings. Is that any part of the capital adequacy? Does a ratings agency look at the capital of a bank and say, you are AAA, you're really good, or you're BBB, you're not so good? Is that a part of that calculation?
Yes, capital assessment by rating agencies is key in their ratings, but they have their own methodology, so they can, of course, they know what the regulation is in this respect. They can look at the regulatory ratios of banks, but they usually develop their own metrics and their own assessment to assess if a bank in particular has enough capital. And indeed, depending on how strong the bank is, the rating may be higher or lower.
There's going to be a Basel IV. Do we know anything that's going to be in it, or what will happen?
Well, it's not yet finally disclosed, but for instance, one thing that is now on the table is to decrease the reliance on internal models by putting, for instance, floors to risk weights that would be applied to different assets. So in a way, it's still the same move that we have already observed. Let's try to, in some aspects, simplify rules, or at least to have a common denominator that can be used for all banks.
Meaning we're not going to take the word of the bank that this is how much their risk is. We're going to figure it out for ourselves as regulators?
They will continue to look at it, but then when comparing banks, they will make sure that at least there is a floor under which, even if a model sounds or looks reasonable, a bank will not go.
Well, we're glad to take your word for this. Regulators might not take the word of banks, but we're glad to have your words on this.
Yeah, thank you. Bye-bye.
Now we really know all we need to know about capital adequacy.
We know an adequate amount about the subject.
No more jokes like that. Why don't you just keep sucking on your Jolly Rancher?
I finished the Jolly Rancher. He is no more. This is a tête brûlée. Anyhow, oh my God, it's awful. It's really, I think it's burning the inside of my mouth. We'd love to hear from our listeners with ideas for financial terms to include on future episodes of the podcast. Or maybe you'd like to tell us your favorite candy. That seems more like the kind of thing people do on social media, doesn't it? You can connect with me at EIBMatt, M-A-T-T.
And I'm Allar Tankler at ALLARTANKLER. Also, please do subscribe to the podcast and rate us.
You can subscribe to the podcast on iTunes, but it's also on Stitcher and other podcast platforms, as well as on our website, the EIB's website. Just go to eib.org/podcast.
And we'll see you for our next episode on A Dictionary of Finance next week.